A protective put is an option trading strategy by which an investor will purchase shares of the stock of a company and then buy a put option on the same company's stock shares. The put acts as insurance in case the price of the shares fall, and it also limits the upside to the investor. Let's jump into Excel to see how these payoffs work and why you might want to conduct a protective put strategy in your own stock portfolio. First, let's go over our variables. So the first one is going to be stock price at initiation, which we'll call SO, and that's $30. So if I wanted to go out into the market right now and buy one share of this stock, it would cost me $30. The stock price at expiration we'll call ST, and I put a question mark because we're going to analyze the potential profits or losses based on a whole wide variety of different stock prices at expiration. The put option premium we'll call P0 is going to be the price that we have to pay at initiation to purchase the put option. So for us to buy one single put, it's going to cost us $4. The strike price, K, is the amount that we have the right to sell the share by that's underlying that put contract when the put option expires. We'll call that, or we'll say it's $32. So basically, a put option gives us the right to sell a stock at the strike price. Let's model out a scenario where we buy one share of this stock and see how much we either profit or loss at all the possible different stock prices at expiration. So I've got right here the formula to calculate the profit if we buy one share of stock, and that's going to be equal to ST, which is the stock price at expiration, minus S0, which is that stock price at initiation. I'm going to hit F4 to lock that in, and then I'm just going to shoot the formula all the way down. And we'll see that it's a direct linear profit and loss payoff. So when the price hits 30, we're exactly even because a stock that we purchased for 30 is still worth 30. So we've not gained or lost anything. Any value above that, we start to gain money. So if we can sell a stock for $40 that we paid 30 for, we're up $10. Versus if we can only sell a stock for $20 that we paid $30 for, we're down $10. And we can see this payoff represented in this orange line. Now, let's look at the profit of just buying one single put contract. And I've got that in this formula. So the profit for that will be equal to the maximum of either that strike price $32 minus the stock price at expiration or 0. And let's talk about why that is. So if I purchase a put option, I have the right, but not the obligation, to sell a stock for $32. And if the price is above $32, I would not exercise that option, so it would just be worth 0. So that's why it's the maximum of the difference here, or 0. So we'll see that if we were just to take the end payoff, it would be up $12 because we can sell something for $32 that's only worth $20, so we're up $12. But we have to account for that initial put premium that we paid, so we will take that out. So we paid $4, so really we'd only be up $8 on this. Let's shoot that formula all the way down. Oh, I have to hit F4 on D5 to lock that sell in. There we go, and now we'll shoot that all the way down. And so we'll see our break-even price on the put is at 28 because we can sell something for $28 or we can sell something for $32 that's only worth 28, so we're up 4 there, but then we actually paid $4 for that, right? So that cuts to 0. And so we can see over here on this graph that the long put starts to be profitable once we cross that $28 mark here. That's where it's at the 0 line, and we just gain more and more money as the price decreases. The most we can lose on the put is the $4 that we initially purchased on the put premium. So now the protective put is just combining one long stock share with one long put. So we can just add the values of each of these together to find out what's our payoff for the protective put. So it's going to be equal to that plus that, and we'll just shoot that formula all the way down. And so what we're seeing here, and we especially want to compare this blue protective put line with the orange long stock line. So orange is if all we did was just buy a share of this stock. Blue is if we buy a share of the stock and we buy one put. Now, why might I want to enter into a protective put contract? Well, you can see in this diagram. So if the price falls below $32, so at all points below $32, the maximum amount of money we can lose is $2. So it caps our loss. That's why it's like an insurance premium. Whereas if all we did was long the stock, we can just keep losing and losing and losing and losing and losing more money. So this is an insurance premium that says all we can ever lose is a maximum of $2. So it protects us on the downside. However, this comes at the cost of we lose money on the upside. So as that stock price increases, see the orange line, we're actually always down $4. We're always down $4 because we're just out the $4 we paid for that put premium. So if the stock price goes up, we're going to be wishing we didn't enter into a protective put. Whereas if the stock price goes down, we'll be glad because the max we can ever lose is $2. If you guys enjoyed this video, please like and subscribe. You can download the file for free in the pinned comment or the link in the description. Thank you for watching and have a nice day.